So to begin, just so everyone's aware, during the session, if you have questions, what would probably be best, because there's a lot of people attending this call, type them right in the chat box. That would be ideal. We can certainly address them at the end. If you are not on mute, everyone will hear you, but I'll probably mute you quick, or just ask that you mute your phone or audio device. So what we will be covering today is policy loans, right? How loans actually work on a life insurance policy. And we're also going to touch on the topic of non-direct and direct recognition, because that does come up quite a bit. A lot of videos out there. So we want to cover that thoroughly, just so we have more of a, or so everyone, I should say, has more of a transparent view and a good understanding on how this actually works. So let's begin. We've got some examples prepared that we're going to go through that illustrate how loans work and such. And to begin, there's a lot of information out there regarding the infinite banking concept and how policy loans work, where it happens probably almost every week just because someone had read a book, or there's some literature out there, or they saw a YouTube video that makes the whole concept appear that when you take a loan from a life insurance policy and you pay that loan and interest back, that we're paying ourselves back. That additional interest, whatever the loan rate is on the insurance policy, is coming back to ourselves. Where you're going to see that's not the case at all, and insurance companies do make money when they charge interest on policy loans. Now, there's a catch to it. They credit us interest as well. So we're going to go through exactly how it works from the consumer standpoint, or the policyholder standpoint, and also the insurance company standpoint. Understanding how they make money is a good thing to be aware of. So some good questions always to ask yourself, and this is whether you're in the industry or this concept is new to you, you're just trying to figure out what it's about before you talk to an agent or someone in the business, whether that's us or anyone, is with policy loans, where's the interest go? Do we pay it back to yourself? Do we pay it back to the insurance company? How do we present it properly or explain it, right? If we're explaining it to a friend or if we're in the industry. And the last point, and I touched on this last week, is always focus on the cash value growth first, right? So with a life insurance policy, and this I'll explain to everyone and anyone, because there's so much emphasis out there on the whole idea of bank on yourself, right? Or the infinite banking concept. Hey, you want to supercharge your account by borrowing and repaying, and that's great. I mean, this concept can work very nicely if everything's set up properly. What's neglected, though, is so much, and we'll focus on this in other calls. That today I want to focus more on loans, but if we focus on growing the cash value of a policy first, meaning we're picking the right company or selecting one of the top companies, and we're allocating money right, where it can go towards premium or it can go towards cash. We're understanding how to reduce this to the minimum and beef up the cash values. That gives us just an overall stronger policy from day one, right? In 99 out of 100 cases. So loans are important. We're going to go through that in detail today, but the first thing that I'd encourage you, especially if you're new to the concept, is make sure you're looking at a policy, an illustration, or presentation. Make sure that cash value is maximized from the beginning. All right. And again, if you have questions, feel free to type in the chat box. What I'm also going to do here is just type in a contact info, an email that you guys can certainly reach out to. If you have any questions, which is our direct email, and I'll write it up on the end of the presentation as well. So with a life insurance policy, and someone is not on mute right now, so I'm just going to mute everyone when I see the call. Whoever's on the phone call, please be sure to mute your audio, just because this is recorded. I hear some kids in the background. Again, this is recorded, so if you can mute your audio, that would be appreciated. Okay. So let's start to go through how this whole concept works. So with a life insurance policy, right, if you have a policy, and let's take a simple example to start. You have cash value built up. We're going to say it's $100,000. It can be any number we want. We'll use a nice round number. You decide to borrow out $50,000. So you have $50,000 in cash, and you've loaned out $50,000. Let's assume that you have a policy where the company is paying you, just to make this simple, a dividend rate of 6%. We're also going to assume we have a loan rate of 5%. Which is a decent spread. You can see that with a couple companies out there. They're paying a 6% dividend, and they've got a 5% loan expense there. So how this would work, right, is if we have $100,000 in cash value and we do not touch it, we're going to receive the dividend that the insurance company is paying us. Now, if we decide to loan out half of it in this example, $50,000, we have a loan rate of 5%. We have a loan expense of 5% in this case, which is payable to the insurance company. So this point I just want to touch on for a second here. Whenever you see a loan interest rate from any insurance company, you'll typically see them range from about 4.75 upwards to 8%, depending on the insurance company. Different terms and variable and fixed. We can go into that in more detail. You can always email us for more info too. But whenever you see a loan interest rate, and you're going to hear me say this several times because there's a lot of misinformation out on this topic for whatever reason, when we pay it back, that does go to the insurance company. So if we let this loan ride for 1 year, 5% of $50,000 would be $2,500. That's money that does go to the insurance company. So if we stopped there, right, if we say, okay, I'm going to borrow $50,000 from my account, I'm going to have 5% loan interest, you can make the argument, well, I'm paying interest on my own money. This concept makes 0 sense whatsoever. Again, if we stop there. Where it works for the consumer, or the policyholder, is whatever that insurance company's dividend rate is. So for example, 6%. That dividend rate is going to be credited to any money in cash value, but also to the money we borrowed out, as if we had never touched it in the first place. A great vehicle to relate this to, just to help one understand the concept, especially if you're new to this or you're trying to explain it to someone that's new, or they're just not quite seeing it because they see the word life insurance and they think death. Right? Again, a good way or good investment to relate this to is real estate. We touched on this briefly last week. So if you own a piece of property, and we're going to assume in a perfect world, that property appreciates at 5% every single year like clockwork. Goes nowhere but up. The appraisal value goes north, zero, decline in the market, keeps going up. Just use simple interest for this example to make the math simple for everyone. If you decide to borrow or take a line of credit against that property, will that ever impact the appraisal value of that property? No, never impact that. So if that home, that real estate is still going to earn 5%, doesn't matter if you borrow all the equity out against it or it's paid off free and clear, anywhere in the middle. You're still going to earn the same 5% as if you never touched it. Same exact thing happens with cash values held within a life insurance policy. Whether we let it sit there and grow and earn whatever dividend rate the insurance company is paying, or decide to borrow a portion of it or the majority of it out, the insurance company is still going to pay us dividends as if we never pulled the money out in the first place. Again, this is being recorded, and if you have questions, definitely feel free to type them in the chat box. We'll address them at the end. So to provide some visuals here, because conceptually this looks great and everybody gets to see my beautiful handwriting. I've got a couple charts we're going to go through here that just show what's a policy look like. And if anyone's ever viewed any videos, or talked to anyone, a lot of times, and this is where some confusion or, am I not being shown everything is typically exposed is, hey, when I take a policy, well, if I've got cash value, I borrow, I repay it, I repay with extra interest, which is a concept we see in Nelson Nash's book. That concept looks beautiful, right? And it's just jumping to the most complicated but most attractive piece of this whole infinite banking concept. If you are considering this, or if you're trying to explain it in a simple manner to a client or prospect, here's really what I would do. And we do this with everyone because it gives them the best case and worst case scenarios. Again, step one, take a policy, maximize it for growth. When you have that policy maximized for growth, or if you're talking to an agent and you've got that piece down right and you're sure of it, step two is, what does that policy look like if I borrow and repay the loan? And when I say repay, I'm repaying the principal balance plus the interest. I'm not being creative and throwing extra money into the account, nothing like that. Just paying back principal and interest. Then, what does it look like when I borrow and only pay the interest? That's good to see. What's it look like if I borrow and pay nothing back? No interest, nothing. I just let that loan balance ride forever. This way we're seeing best case scenarios, worst case scenarios, but we can always compare that as, okay, looks great. A lot of times these charts are hard to follow. When I compare any one of these, what's it look like compared to the original model where I just let it sit and grow? That always gives you a gauge to properly compare a model, and also find out if the policy is properly designed, or if the numbers are accurate from the insurance company. Okay, so we'll get more into repayments. Let's just touch on this quick now, because once we get into the charts, I feel like we're going to have a handful of questions. So when it comes to policy loan repayments, you may have heard you never have to pay back. You may have heard repayments are optional. Both are true, right? When we're in retirement, a lot of people use these accounts as a means just to supplement income. And what they're doing is taking disbursements from the cash values of the life insurance policy. A lot of times loans are heavily involved there because it's a great means to get the money out tax-free. And they're paying nothing back. You're going to see how the insurance company benefits, how this works. Our death benefit is collateralized as a result. So it's a win-win. It's a win-win for us because we pull money out tax-free, but the insurance company is on the hook to pay out less. They don't mind that. That's their first and foremost obligation. If we're using the money heavily and we are repaying, if it's set up right, it is extremely easy and convenient to do so. You're going to see, especially if you have a policy, you may have experienced this already. Taking loans and making repayments are as easy as going on an online account, requesting a loan. The insurance company sends the funds direct deposit, or they mail a check. Same thing with a repayment. It's a lot like paying an online credit card bill. We go right online, punch in the amount we want to send in, pay it back. The only difference is we have no due dates, right? With life insurance policies, we're in control. Hence, part of the reason where the whole name, the banking concept, comes from, because we're the bank. We're not paying back to a bank. So some of the samples, let me blow this up for you guys, we're going to walk through here are what do life insurance policies look like, and we're going to look at a couple options. We're going to look at what a policy will function as, what it looks like. First, with maximizing the growth. So we're going to see a contract where on a 45-year-old male, we pay in $50,000 for 10 years. Again, these funding scenarios can be 5 years, they can be forever. We'll focus on that in a different call. This is just going to show $50,000 for 5 years, maximized for growth. This is a high cash value policy. So for those of you that may have been exposed to this before, this is high upfront values. A lot of different types of policies, which again, we'll get into the future, but great means to provide early access to cash. And you're going to see this policy compared to examples where we take loans, fully repay the balance. Examples where we borrow out, let me blow it up here, pay nothing back. And then what it looks like if we borrow out and only pay the interest. And by the way, anytime you take a loan from an account, these models are designed to help simplify the concept with borrowing and repaying, just showing you what you can do. In reality, you or the person you're setting the policy up for can do whatever they want in terms of repayments, right? So these show regimented schedules just because it's cleaner. That's the main reason why. In reality, again, you can do whatever you want. We can model whatever we want to. So just to FYI, I think someone is on their phone. Just make sure you mute yourselves because this is being recorded. Just to FYI, and then we can certainly open it to questions at the end via the chat box, or you can email me. So let's look at a couple options here. Why don't we start with the best one, because this is what everyone jumps to if you've ever seen an example before, is what this is going to show. Again, a 45-year-old male, a policy where he's paying $50,000 a year for 10 years, break-even point just about year 3, 0 payments thereafter, and just lets the cash ride. Then we want to compare it to the identical policy. The difference is we're going to take out loans and we're going to repay them. So while we're on this topic, when you can take a policy loan. That's a question that comes up frequently. Let me just draw this out at the same time. When can you take them? How often can you take them? Well, the answer is anytime you want, especially with the top companies. There's no restrictions on when you can take a loan out, whether it's the day after you start a policy or if it's every day, right, as many times as you want. Mike, good question. How does this work for seniors 65 and over? Same thing. That has a bit more to do with the policy design and making sure that the cash value is really maximized up front. But a lot of times we'll work with people in their 60s, even early 70s. You can still make this work. Back to the loans. Take them anytime we want and as many times as we'd like. So this example is going to show 2 loans coming out of $150,000. Pretty straightforward in the sense we take them out. The first thing that I want to highlight here, and this is the most important piece to look at, is when you take that loan out, what do you notice on the death benefit compared to both examples? And the difference in value there. You're going to find it's always going to be exactly the amount or right around the amount we pulled out, the $150,000. It's actually $150,000 plus another $7,500, the loan interest expense. Here's the main takeaway for you guys though. Whenever you borrow from a life insurance policy, you will see your death benefit reduce by the amount you pulled out, $150,000, or if it's $1, whatever, you'll see a dollar for dollar reduction there. That is what the insurance company is holding as collateral, and that's how, going back to the concept when they still pay you dividends on your entire bucket of money, you're going to see that here in a second. That's how they do it. The death benefit's held as collateral. View your cash value really as your line of credit. So year 4, we had $203,000 in. Year 5, looking at the example on the left, you've got $259,000, just about $260,000. We pulled out $150,000. There's your remaining equity. Let's call it that. So we cannot put in $1 and immediately borrow against the death benefit. That's just a point I want to add in there, because some of the information out there makes it sound like that's the case. You know, I've spoken with a lot of people, some of which are affluent individuals. They knew you couldn't do it, but the literature they were exposed to made it appear as if you could. So whatever we can, the amount that we can borrow against at any time, again, is whatever we have in cash value. So when we pull out $150,000 here in year 5, after we've pulled it out, that $102,000 is how much additional cash we could pull out if we wanted to. Now, we pay it back, $50,000 a year. We pulled out $150,000. If you tally up those repayments, how much had we paid back? More than $150,000. Right? We paid back just about $167,000. Right? So if you tally them up here, we took out a loan of $150,000 and you repaid $166,820. This means that the additional interest, guess where that went? It did not go back to us. It went to the insurance company. So loan interest expense always goes to them. Here's how it works for you and I if we own a policy. When we see that loan repaid, let's look at the year it's repaid. In this example, that'd be year 8. What I want to focus on here, I'm sorry, that'd be year 9. So in year 9, our cash value, $489,000. Right? What we want to do here, actually, let's look at our death benefit too, $2,016,000. Compare that to the example on the left, where we just let the money sit and grow. We never touch it. You're going to see that the values are 100% restored to exactly what they would have been if we never pulled a loan out in the first place. And that's going to be the case if we pay a loan back like clockwork. Right here, we borrow it out, pay it back really fast. If it took us 40 years to pay it back, and some years we made 0 repayments or any period of time, whenever a loan's repaid, you're going to see this occur. Every time in non-direct recognition, and we'll get more into that, but once a loan balance is repaid, one will see their cash values and death benefit fully restored to exactly what it would have been if we never pulled money out in the first place. How they're doing that is, remember, they're paying you dividends on your entire bucket of money. So yeah, you pulled out 150K here, but they're still paying you interest on your entire bucket of equity with the full appraisal value of your policy. Okay. Same thing down here. Pull out the same loan, pay it back. Main point to illustrate. And again, this is being recorded for those of you who just hopped on so you can catch the earlier part of this. When the loan's repaid, everything's fully restored. All right, a lot of times we can add another column in here that just shows the dividend and interest that's paid on both examples, and you're going to see that's always the same. The other models, you can go through these a little bit quicker. These are great to compare policies to. Right, so here, again, compare it to the example where we let it sit and grow. We paid in $500,000. Example to the right, we pulled out the same loans, but we paid nothing back. We didn't even pay the interest. We just let this thing ride. This would be a worst case scenario. Can't get any uglier than this. All right, in this example, so that loan interest continues to add to the loan principal. What's interesting about this is if you look at the death benefit, subtract the loan balance, you're going to see there's your delta in the insurance amount as the years pass, just about that figure. The end of the road, we can go down further. This is just a 30-year study. All right, so we've got a large loan balance on the account. You've still got close to $300,000 in cash, $1 million in insurance. All right, so if you set things up right, you can still get away with this. Yeah, it's not optimal, right? But this was an account where more or less we paid in $500,000, pulled out $300,000. So you had $200,000 remaining, but it still grew, and you still have life insurance. Again, most people who practice the banking concept don't do this, but it is great to see because not everyone who's practiced the banking concept has had a perfect life. Not to say any of us have a perfect life, but a scenario where everything went according to plan. Life happens, right? It's good for you to know what would happen in a worst case scenario. Whether this is your loan strategy or if it's loans every year, whatever one's exact plans are, or hey, what's it look like, you want to see that worst case scenario. This way, if things go south, the policy blows up, we're not left on the hook. We were made aware of it in the beginning, and then it's going to impact our decisions, obviously. Here's a nice example shows the policy. Again, same example on the left. Let it sit and grow. But compare it to the same policy. Take out the same loans, but now we're just going to pay the interest forever. And if it's in purple here, this loan repayment, this does mean that it is an out-of-pocket repayment. So our loan balance never grows because we're covering the interest expense out of pocket, making zero policy contributions at this point. Still grows at a nice rate. All right, and there's ways to measure the returns. We'll have a a webinar on this in the future, how to measure returns on policies, more upfront, more long-term. We'll go through all that good stuff. Point we want to illustrate here is if we're covering the loan interest expense, remember the insurance company is always paying you dividends and their guaranteed rate. So if you're covering the interest expense out of pocket and your policy's paid up, in this example, there's no more premiums due, that cash is still going to go. There's no drag on it. So always good to see these examples. Again, you can review this in the recording. I know a lot of you had requested the first recording, which you can just email me or the email I put in the chat box to request it, or you'll get an email from our marketing team afterwards if you'd like it. Just request it and we'll send it to you, where you'll see these charts. And this is generic, a 45-year-old male, but gives one an understanding on how it actually works and what you want to ask for and identify instead of just seeing the best case scenarios. Okay, so let's touch on one more piece and we can wrap up here. That's me, by the way. There's the whole piece of non-direct and direct recognition. Right? Because there's so much material on this on the internet, and if you're talking to agents working for different companies, they fight with each other as far as which strategy is the best. You want to go this way, right? And we're going to go through exactly how it works here. And then we'll add a twist to it for everybody to make it more fun. Right, so let's use the first example we had, where if you've got a policy and you've got cash value of 100 grand, let's say you've got, you know what, let's do this. Let's say you've got a Mass Mutual policy, one of the major mutual companies. 6.4% is their dividend rate. Their loan rate is currently 5%. So identical scenario. This is going to be what we just drew out in the beginning. You borrow out 50. We pay a 5% loan interest expense, in this case to Mass Mutual. However, they still pay you a dividend rate of 6.4% on the full 100, as if you never pulled money out in the first place. So you don't lose a step. You're still earning interest of whatever their dividend rate is each year indefinitely. That's not going to change. Regardless if you have a loan outstanding, pay just the interest, pay it back in full, doesn't matter. You're going to continue to get the same interest rate. Will not be impacted. A direct recognition. Let me back up for a second. So why you have the wording there, non-direct recognition, is that they do not recognize that you're taking out a loan. They're still paying you interest. A direct recognition company. Same scenario. You can imagine what the direct recognition means. They recognize that we take out a loan. $50K in cash. We borrow out 100,000. Now, if anyone's done any research online or talked to an advisor, or if you're an advisor and you're trained, hey, direct recognition is bad, a lot of smaller companies will reduce the dividend rate. I can't tell you how many times I've spoken with someone and they said, yeah, I'm talking to another agent and I'm looking at a direct recognition company because I like their financials. And they said, anytime I borrow, they don't pay a dividend on borrowed funds. It's not the case. It's not the case at all. What that means is if you have a dividend rate, any money in cash value will receive whatever the company's standard dividend rate is. The money that is loaned will receive a different dividend rate. It could be higher, it could be lower. We're all about giving you as much information as we can here. So here's what we're going to lay on you. If you were to use a smaller company, and what I mean when I say that, smaller direct recognition companies, mutual trust, A-rated, very flexible, have a lot of upsides. Penn Mutual, A-rated, flexible, a lot of upsides, and we can list a lot of them. Typically, when you borrow, and actually you can make a Mass Mutual account direct recognition, and they'll function in the same way. We never do, but you can. When you borrow, they're going to take your dividend rate on borrowed funds and reduce it. Not attractive. There's a nice workaround that. In that Mass Mutual note, we always want to elect the non-direct recognition to avoid that. Last week, I touched on the 4 major mutual companies always crediting the highest returns based on historical performance. So we've got proof of that. 2 of those companies are direct recognition, Guardian and Northwestern Mutual. And FYI, for anyone on the phone or computer, do be sure to mute your audio. Here's some music in the background, and this is being recorded. Okay, so take a company like Guardian, for example. Again, Guardian is direct recognition. Northwestern functions in a similar matter. Guardian has a dividend rate of 5.85% presently. Clear out some space here. They have a loan rate, which is fixed, at 6%. On paper, not that attractive. It's a negative spread. If we borrow, it's going to cost us, right? Here's what they do. And again, Northwestern does something very similar. When you borrow out $50,000, the money that is still in cash value will get whatever the dividend rate is, 5.85%. The money you borrowed out, what are we paying on that? 6%. Guardian is still going to pay you a dividend on that. The dividend they're going to pay is 6%. They match that to make sure that it equals the loan rate. Here's their big thing. Again, Northwestern does something very similar, a little different, but we don't have to go into that tonight. They do not want policyholders to feel like they're going to be punished for taking out a loan. So if we borrow funds, they're still going to pay us a dividend on the entire $100,000 if we never pulled it out. Here's how it's going to work. Money that's unborrowed, okay, we're going to credit you a 5.85% rate. you did borrow some funds out. So on the borrowed amount, on that portion, you're going to get a 6% rate. We can draw some models and charts up on that if you'd ever like to see it. The only thing that happens there is if you borrow and repay large balances or at a high frequency, you just see the values a little bit stronger when it's repaid, because you are getting a slight enhancement on the borrowed funds as long as it's outstanding. So quick overview on non-direct and direct recognition. Quick recap. If you're ever trying to give someone the quick overview, non-direct recognition is easy. They do not recognize the fact that you take out a loan, and they pay you the same interest no matter what. Going back to the real estate example, you earn 5% a year, appreciates like clockwork. Doesn't matter if you have a mortgage outstanding or not, you're getting paid. Direct recognition is the same thing, except the amount you pull out, the company is going to change the crediting rate. Here's what they're going to pay. And depends on the insurance company. If it's one of the major mutuals, what's really interesting about that is typically you're going to see them enhance it. They're going to pay you more interest. They don't want you to feel like you're punished. Smaller companies are typically what you read about online, where they reduce the dividend rate. But it's not a huge amount compared to the dividend. Often doesn't make a huge difference. I don't think that factor alone should ever make or break a decision as far as a company. This would be a great topic to cover next week, which is policy flexibility. Right? How do we easily adjust our contributions, whether we adjust them yearly or if we just pay the minimum and dump extra money in at leisure? How do we treat it more like a flexible savings asset and less like a boring insurance bill where we pay the same amount every month or every year? Now, how do we get creative with the thing? So all of the pieces, how to borrow, right? How to repay, the flexibility we'll touch on next week. These calls, right, are really meant to give you more information. And again, I'm giving the information, regardless of who anyone decides to work with. You can always reach out to us. How we ultimately run the business is by setting up policies for individuals. Do policy sales. For those of you that have worked with us or with me, you're used to my style at this point. Typically, we go through a lot of the information we touched on, but in particular on the policy design, building the policy out together so you know how you can use it and putting you in the driver's seat. That's always optional. These calls are recorded and sent to anyone who requests them for a reason, just to make sure that the information provided is transparent to everyone. Because this concept is not that transparent, especially when you see the 18,000 YouTube videos that are all different. That's a good ending point. We can open it up to questions. If anyone wants to type in the chat box, that'd be great. And once we conclude, then we will make sure we convert this recording and send it out to anyone who requests it. Type my email address here again if you have questions. You can email me here or just reply right to the individual or the email that you had received the link from. If it's a Real Wealth Financial, that would have came from Nick and Jake, or if you saw it through one of our social media vendors, whatever it might be, feel free to reach out via email if you have any questions, or if you have a number, you can call us. Something in the chat box here. Mike, good question there. Let me get this chat box over here. Do I need a 10-year deposit rate, or can I lump sum it? And how does this vary by state, in particular California? So you can lump sum fund a policy depending on one's age. You might want to spread that lump sum up over a couple years. That just has to do with the interest earned, or the interest the insurance company is crediting, and the insurance expenses. But typically, depending on one's age, you're going to see a 10-year funding period. If you put 100 grand in over 10 years or over 2 to 5 years, doing it over 2 to 5, again, depending on your age, will be more efficient. So the short answer is a lump sum is more efficient. You just want to see what the optimal number of years are. Yeah, sure, Charles. Thanks for the kind words. Appreciate it. Yeah, Mike, if you want to see any examples on that, just feel free to shoot us a note. If you're in the industry, we do work with a lot of agents, and you can always test us out too first. So zero pressure, kind of independent setup. Any other questions before we wrap up this evening? If not, again, feel free to reach out anytime. You can shoot me an email. If I don't respond to you directly, someone in my office certainly will. We try and have a fast turnaround time. Okay, Mike, how is it determined to be an insurance policy or investment? Great question. Has a lot to do with the MEC limit. So if you had a chance to look at last week's meeting, the recording, just shoot an email either to the address I have up here or to the email that sent you this link, and we can have that sent to you where we touch on that. So has 100% to do with the MEC limit, which has a direct relationship to the death benefit. So that recording handles it, or I can go over that with a call for you or email you some info on it too. Good question, though. Comes up quite a bit. Yeah, no problem on that, Charles. Happens quite a bit, and that's not a disservice to your clients at all, because that company does work for the concept. If you want to shoot me an email, just to the info email I have up here, feel free, or the Real Wealth address if you got that from the guys. We all work together, so it doesn't matter. Yeah, can certainly go over some stuff, send you some examples. If you're using them right now and it's working for you, you can enhance things quite a bit, with some other companies and strategies. Switch to you prefer. I think, Vic, you meant, so which do you prefer, direct or non-direct? Good question. Our book of business with everyone we work with is actually split between the companies and the major mutuals 50-50, believe it or not. And that's something I'll go through with each individual. Hey, here's how to set it up. Here's the pros and cons. Here's the flexibility. This way, the consumer sees the options up front. We put it in a simple format so it's not confusing for them. And then they don't have buyer's remorse. They don't think, hey, you didn't show me something, and learn about it 6 years down the road or something like that. Sure. Dave, do you need a new policy or can you convert one to this type? So when you say convert, if you have a term policy, you can convert that to a whole life policy. If you have an existing cash value policy, whether it's whole or universal life, you'll be able to use it for the concept. It's just a matter of how is it set up and could the cash value returns be stronger or not. That's the main thing there. But yeah, you can have the worst policy in the world that took 20 years to build up cash value, but if you're at year 20 and you've built up the values, you can use that account to practice the concept. Hey, thanks, John. Appreciate it. Vic, good question. Are they always IULs or traditional whole lives? We're going to have a webinar on that probably in about 2 weeks, because that question comes up all the time. IUL or whole life, which one's better? They both have pros and cons. I primarily use whole life only because of the historic real-time performance and working with large corporations, the major mutuals. I know they deliver. However, it's someone a little bit younger looking for more potential, and IUL gives you that. So we're not going to turn someone away because of that. We just go over the pros and cons to both. Concept can work with both. Traditionally, it's been more so with whole life, but if someone's looking for the potential to yield higher returns, the IUL will give them that. All right, next question. Yes, Mike, I can do that. You just jot that down. Okay. Okay, Dave, I see. So cash value, but not optimized for growth. So yeah, you could practice the concept with that account, just not optimized for growth. So kind of going back to the key point, starting a policy before I look to explain the concept, really like to focus on the growth, because if that's maximized for the policyholder or the consumer, they're happy no matter what, right? Whether they use it for just a retirement asset, cash value, or if they use it for the banking concept heavily, if you've got more money, you've got more money, whether it's just pure returns or for this concept. So I'll look to do that first, but to answer your question, sorry for me rambling, you can use that policy. There just might be ways to give you more or your client more. Good question, Vic. What's younger for an IUL strategy? Typically someone mid-40s or below. The only issue with the universal life is as you get up in age, those insurance expenses get more and more expensive. More people get into trouble. So if you can get ahead of those costs, it can work. And on that training that we're going to have, I keep calling it a training, that webinar, we'll probably have that one in about 2 weeks. You're going to see whole life, universal life, and there are actually products, people aren't aware of this. It's a whole life product with a fixed insurance expense, guaranteed values that always go up. They never decline to zero, but an indexed rider instead of a dividend. So people that want that strong guarantee, but still have the upside potential of the market, the S&P 500 index, it's a nice option. Sure thing. Thanks for the questions. All right, I'll give it another minute. If any other questions. Mike, that's true. So where the insurance costs can be high, if you were 65, is if you were buying a life insurance policy for $500,000 and you're price shopping or quoting, okay, show me a whole life, universal life, term life for the X amount of coverage, yeah, then you get into a price standpoint where the way to design that actually, so there's times we work with guys who are 65 that put in 10K a year, guys that put in 200K a year, 65 or older. What is always consistent there is when you pay money into a policy, it can either go towards insurance or it can go towards cash. You'll see me touch on this more on the last week's webinar that I'll have sent to you. And they can also send some samples for seniors, whether you're looking into it for yourself or you've got a client looking for that. But as long as that insurance expense is minimized, now the cash value is the prime focus. We just kind of let the death benefit fall where it falls to start, and then we can raise that or lower it. Some visuals might help. There's times we take policies on 65-year-olds, and they're stronger than a traditional contract and a 30-year-old. So Vic, options cost money, so an experience on a 45 years old you would add to those whole life with hybrids. Okay. If you want to send some more info. That's correct. I do prefer the dividend. People that want more potential. So that whole life hybrid still has the guarantee of 4%, and it's actually not one or the other as far as the options. So how it's set up is one can elect. That particular example is through Guardian, where you can say, I just want the dividend this year, or I just want my funds tied to the market, or I'd like half of my funds tied to the S&P 500 index and half of it tied to the market. So this is a newer concept. It's been available for about the past year and a half to 2 years and not picking up much traction because people don't know about it. We've been offering it more and more, but it depends on one's flavor. Good alternative. Again, just seeing the options is the key. You are correct, though. From my experience, I prefer the dividends because they've actually delivered. Very welcome. Good questions, guys. Someone for your age, so you say 65 plus. How old are you? 65? Yeah, so Vic, just either to the email I have here, info@ibcglobalinc.com, or where you got the link, it was from the Real Wealth info. Just reply to that, say please send recording. You'll get emails, or you can email me directly or Natasha at the office if you're the Victor that I think you are. If you're not, I'm sorry. Mike, yes, you're 65. Okay. Are you in the industry, Mike, or are you looking at a policy with another agent and just trying to figure out how it works? $65, some examples. Interested? Sure. Okay. Yeah, so we actually just ran a sample. It was for a 65-year-old male. I can send that one. He's looking at about $100,000 a year for 5 years. So I'll send that one because it'll be very quick. It's already produced with a couple different companies. And just keep in mind, whether you're looking at $1 million a year or $10,000 a year, the ratios will always be the same or very similar in terms of a break-even point, performance. If you'd like a custom proposal based off numbers, you don't have to type that in the chat box. You can reply to the email I send you, or you can, send one to the one I have up there in the screen, and just let me know kind of what you'd like to see as a sample, and we'll put you a custom one together for you. But in the meantime, I'll send you the one we just completed. Go back out, make sure I've got your email correct. Perfect. Okay. Any other questions before we wrap up? Regarding the banking life insurance concept, is it ideal for 50 and below, working not retirees, RMD, not needing cash value? No, I mean, it'll work well for them, but a lot of people we work with over 50, people in their late 60s. Where that's a good question. The age group there really has to do with the individual's preference. Most people who are older typically are not practicing the banking concept, which is just funding a policy, borrowing, repaying, and being creative with it. However, some do. There's been a lot of guys we've worked with in their 60s that don't slow down. So more of a preference there, Vic. Someone's on the phone, FYI, and we can hear you. Sounds like you're at the dinner table. Yeah, doctors, 60 years old, retiring at 70. Yes, yeah, that can work. What I will let you know is if their health is decent, if they don't have any major health issues, if it's a male, when someone gets into their mid 70s, it does get expensive no matter how much you blend the policy. But if they're in their 60s, yeah, that's no issue. Good question. Okay. All right. Could you do a webinar comparing term and invest the rest in this concept? Sure. Sure. We've got the next two lined up, but maybe the one after. In a nutshell, why would I ever want to pay more interest than due on the loan? Oh, good question, Dave. So you mean the whole concept of pay extra interest back to yourself? Where you see that? I just want to make sure I'm on the same page before we start explaining it. Yeah, yeah. So what that is, it's confusing sometimes. When these videos or what Nash is alluding to, because it can work beautifully, if you've got a 5% loan rate and you pay it back at 10%, what that means is you pay it back at 10%, the 5% loan cost went to the insurance company. The additional 5% was just extra cash, PUAs. You added more money to the policy and enhanced the growth. The thing that should be explained up front, and it's not, is you don't have to have a loan to pay yourself back more interest. You can throw extra money into the cash anytime you want. Works beautifully. I mean, the way Nash put it in his book, I mean, you're functioning like the bank from a discipline standpoint. It's great. I think just a lot of people have kind of taken that, in their marketing and such and confused it. All that means is when you pay extra interest in, you're adding more money to the cash value of the policy. Sure, sure. And if you're looking more into that, I would always go to the source there through Nash. We work with him. We're a practitioner through him, but he's the guy who started it. A lot of people will spin it to make it sound different. Okay, let me see that question here, Vic. Thanks, Dave. I get many that life insurance bad investment and going financial planner, buy term and invest in the market. Yeah, we kind of get almost sucked into that fight. A lot of times the financial advisor and the insurance guy go this way, now go that way, and they fight with each other. Here, yeah, that good question. That's good for another webinar. A lot of ways to handle that. I come up against it quite a bit as well. But yeah, if you want to shoot me an email, we can coordinate a time to go through that as well. Just because we're a little past the hour here. Another question, Charles, when you pay yourself back, that is only up to the maximum yearly contribution for your policy, else you might MEC. Is that correct? That is correct. If you had a chance to review the earlier or last week's webinar, especially on the point with the MEC limit, you can set your MEC limit wherever you like in the beginning. And that's something we actually show someone how to do. So when they want to practice this concept, we're going to make sure we set that MEC limit at the right number so we don't run into that issue there. But if that's not the case, if the MEC limit isn't set up, you're correct. Oh, so this is the second one we did. I've been told I should be doing this for years and didn't do it until recently. And well, I hired a business coach. But thanks. And this is a means of our marketing too. So, I mean, you know, a lot of times if you guys reach out, you know, we're trying to generate more interest. You can always feel free to reach out for one-on-one. It's the same presentation style. Now, so MEC limits have a direct relationship to the death benefit on a life insurance policy. Mike, good question. That's something. So, Mike, in that sample I'm going to send you, with the 100K going in, the MEC limit is going to be 100K. So, if someone says, I want to pay in 10,000, 100,000, or a million a year, we're going to set the death benefit at whatever gets us the minimum needed so the policy doesn't MEC. So, you won't see any impact on the state. We're licensed in all, I'm licensed in all 47 of the 50 states. That's never been the case. Sure. Thanks, Vic. Thanks, Charles. Can certainly get that to you. Yeah, and when I'll be available to answer questions, either if you reach out via email, me or my office will, um, and then these webinars, obviously. Good question, Vic. I'd have to check 3 of the states where no one lives. Sorry, let me just take care of that. So I shouldn't get licensed also. No, it's a good idea to get licensed. If we had business in those 3 states, we'd get licensed. I just don't think our marketing reaches there a whole lot. 3 states. Guam might be one of them. I'd have to check with their licensing department. Years ago, I did all that. Now I just had hired people to help. Okay. Very welcome. Well, I think that's good, guys. Any other questions, do reach out. So I'm going to wrap this up here and have the recording probably prepared. Tomorrow it'll go out to everyone per request, so we don't just blast them out to everyone. These are typically the people that request them. Just an email to me or to the where you got the invite from. Physically, Vic, I'm in Pennsylvania. Yeah, up in the Poconos. 1% of our business is held in office. Okay, yeah, nice. Florida, yeah, my business coach is down there. So I consulted with him one-on-one, and then for the company, the one-on-one helped me a lot. Cardone, Grant Cardone, high energy guy. Yeah, nonstop. Personality is a lot different than mine, but so I mean it's helped. I'll just leave it at that. No, not in insurance actually. He's real estate and then some consulting and sales training he does. Yeah, I just like a lot of his follow-up techniques and his approach. Yeah, big in real estate. Cool. All right, I'm going to grab some dinner. Any other questions? Feel free to reach out. Take care, guys.